Welcome to Tech Money Madness Weekend Edition, your bite-sized investor education series. Today's topic, chart patterns, head and shoulders, double tops, and more.
Glad to be here.
So, have you ever found yourself lying in the grass on a summer day, just staring up at the clouds?
Oh, yeah, definitely.
Right. And at first, it just looks like, a random collection of white fluff.
hmm
But if you stare at it long enough, your brain suddenly decides, oh, look, that cloud is a dog. Or, I don't know, that one is a sailboat.
Yeah, you just start projecting shapes onto it.
Exactly. And the crazy thing is, traders do the exact same thing every single day. But instead of clouds, they are staring at squiggly lines on a stock chart, looking for shapes that might just, tell them where the market is heading next.
It is honestly a perfect comparison. Because
That-
when you first open up a stock chart, I mean, you're just hit with what looks like absolute chaos.
Just noise.
Right. Just a jagged, seemingly random line bouncing up and down across your screen.
Yeah.
But according to the field of technical analysis, there is actually a hidden visual language in that chaos. Like if you know what to look for, the market is constantly leaving breadcrumbs about what might happen next.
Okay, so I actually went straight to Wikipedia to grab a baseline definition just to anchor us for this deep dive. And it says a chart pattern, which is sometimes called a price pattern, is a distinct formation on a graph created by the movements of security prices.
Okay. Yeah.
But the fascinating part of this definition is the claim that these patterns naturally occur, they repeat over time, and traders use them as either reversal or continuation signals. But, with real money on the line, how is searching for a sailboat in a stock chart any different from just guessing?
Well, that question sits at the absolute center of a massive debate in the financial world right now. Oh, yeah. If you look at our notes from Investopedia, they argue that identifying these repeating patterns is crucial for investors. I mean, they view it as a primary method for predicting price movements, identifying trends, and, knowing exactly where to cut your losses.
So for a lot of people, this is their whole strategy.
Exactly. For countless technical traders, recognizing these visual formations is literally the foundation of their entire livelihood.
Wow. I'm sensing a pretty massive divide here, though, because our sources from the CFA Institute, and that's the organization that actually trains chartered financial analysts, they paint a very, very different picture.
Yeah, they do.
They point out that while these visual cues are used by traders globally, the actual effectiveness of chart patterns is still hotly debated among academics. Like, they aren't fully sold.
No, not at all. You have practitioners swearing by these methods on the trading floor, while academics in university finance departments are looking at the empirical data and saying, we're highly skeptical.
So what's the academic argument?
Well, the academics argue that markets are largely efficient and that past price movements just shouldn't dictate future results.
Makes sense.
But the traders counter that human psychology never changes, right? Fear and greed are constants. And because chart patterns are essentially just visual representations of human fear and greed, they're always going to repeat.
That psychological angle really makes me want to look under the hood here, because if the academics think it's just financial astrology, but the traders are out there betting millions on these shapes, we really need to understand the mechanics of how this is actually supposed to work.
For sure. Let's get into it.
So our sources highlight three very common formations, and I want to start with the most famous one, the head and shoulders pattern.
Yeah, that is arguably the most recognizable pattern in all of technical analysis.
And the name sounds incredibly straightforward until you actually read the description. I have it right here. It says this pattern consists of, quote, a peak the head, followed by a higher peak, the left shoulder, and a lower peak, the right shoulder.
Yep, that's the standard definition.
Wait, we have to pause on this visual for a second. A peak for the head, followed by a higher peak for a shoulder. That is anatomically bizarre.
It's a little weird, yeah.
What kind of human has a shoulder stretching up higher than their actual head? This sounds less like a person and way more like, a disjointed Pablo Picasso painting.
You're not wrong. The Picasso analogy is pretty funny. But visual jokes aside, you're hitting on the exact right concept when you start thinking about the tension there. It's really a tug of war.
Okay, tell me about the tug of war.
So the head and shoulders is what we call a reversal pattern, meaning it signals that an upward trend is basically exhausting itself and is about to turn downward. We kind of have to look past the funny name and focus on the psychology of the buyers and sellers, creating those three distinct peaks.
Okay, walk me through that psychology then. What is actually happening during that first peak, the so-called left shoulder?
All right. Imagine a stock has been on a massive winning streak. Okay. It's climbing steadily. It surges up to create a new high. That right there is your left shoulder.
Got it. The stock is doing great.
Right. But then people who bought in early decide, hey, I want to take some profits. So they sell, and that causes a temporary dip. But the broader market is still feeling very, very optimistic.
So they buy the dip.
Exactly. A new wave of buyers rushes in, pushing the price even higher than that first peak. And this massive euphoric surge that forms the head.
Okay, so the bulls are in total control during the head. I mean, everyone is just buying, but then it dips again, right?
Yeah, it dips again because the smart money starts exiting the trade at the absolute top. And now comes the critical moment.
The right shoulder.
Yes. The price tries to rally one more time. The latecomers, the people suffering from fear of missing out, they start buying.
Oh, man, the FOMO buyers.
Yep, the FOMO crowd. But this time the momentum is just gone. The selling pressure is too strong. The stock rallies, sure, but it cannot reach the euphoric heights of the head. It forms that lower right shoulder and then just begins to drop.
Wow, that paints an incredibly vivid picture. I mean, the weird anatomy isn't just a shape. It's literally a visual record of exhaustion. You can physically see the buyers running out of steam on that third attempt.
That's exactly it. The buyers throw everything they have at it, fail to reach a new high, and finally just surrender to the sellers. That is why it signals a major downward reversal.
Okay, let's move to the second pattern from our sources, the double top. Now, this one is much easier to picture in my mind.
Oh yeah, it's very simple visually.
It's described as another reversal pattern, but it consists of two distinct peaks that hit roughly the exact same price level. So visually, it just looks like a giant letter M on the chart. But what is the behavioral psychology creating that M?
So the double top is a perfect illustration of a concept called resistance. The price climbs up, hits this invisible ceiling, and then drops. That forms the left side of the M.
Okay.
Now think about the investors who bought at the absolute peak of that first spike.
Oh, they are probably kicking themselves as soon as the price plummets. I mean, they're sitting on losses, feeling massive regret.
Oh, severe buyer's remorse.
Mhm.
Just kicking themselves, like you said. So now, say, weeks or even months later, the stock manages to climb back up to that exact same peak. What do you think those investors, the ones who bought at the first peak, what do they do the second the price reaches their original entry point?
Oh, they sell immediately just to break even. They just want off the roller coaster.
Exactly. And that mass rush to sell creates a massive wall of supply. It acts as a ceiling that the stock price simply cannot break through.
Wow.
The market refuses to let the price go any higher because there are just too many eager sellers waiting at that specific dollar amount. So the price hits that ceiling a second time, gets rejected, and drops, forming the right side of the M. It basically tells the trader that the upward party is over.
That makes so much sense. So both the head and shoulders and the double top are screaming at us that a U-turn is coming. But is there ever a pattern that just tells you to stay the course? You know, a signal that a trend isn't dying, but just kind of catching its breath.
Yeah, absolutely. And that brings us to our third pattern, the triangle.
Okay, the triangle.
Right. Unlike the first two, the triangle is a continuation pattern. Visually, it looks like a series of higher lows and lower highs. The price swings are basically just getting narrower and narrower.
So the range is tightening. Like if you draw a line across the tops and a line across the bottoms, they sort of converge. It looks like a coiled spring getting squeezed tighter and tighter.
That's a great way to put it. The psychology here is indecision leading to a consensus. The buyers are willing to step in at slightly higher prices each time there's a dip, which forms those higher lows.
Right.
But the sellers are equally eager to take profits at slightly lower prices each time there's a rally, which forms the lower highs.
So they're just clashing in the middle.
Exactly. The battleground shrinks. The tension builds. And eventually, that spring has to release. When the price finally breaks out of that squeezing triangle, the expectation is that the localized indecision is over, and the stock will aggressively continue in the direction of the original trend.
Honestly, this changes everything about how I view these charts. We aren't just looking at abstract art. We are looking at the localized emotional state of thousands of people trying to outsmart each other.
Precisely. It's all psychology.
But spotting a coiled spring or a letter M is really only part of the battle, because our sources lay out a strict 4-step process for actually applying this knowledge.
Yes.
Yeah.
And step one is choosing your chart type, because you have to decide how much data you actually want to see.
Right.
You could use a simple line chart, which just plots a single dot for the closing price of the day and connects them. It's clean, sure, but it leaves out a massive amount of context. That is why most technical traders use candlestick charts.
Okay, I always see candlesticks on the monitors of day traders in movies,
Yeah.
those little green and red rectangles with sticks poking out of the top and bottom. But what extra context are those actually giving us?
So a single candlestick tells the story of an entire trading period, let's say one day. The colored rectangle, the body, shows you exactly where the price opened and where it closed.
Okay, got it.
If it's green, it closed higher than it opened. If it's red, it closed lower. But those little sticks poking out, which are literally called wicks, those are the most important part. They show you the absolute highest and lowest prices that stock hit during the chaos of the trading day.
So a really long wick pointing up means the buyers pushed the price incredibly high at lunchtime, but by the closing bell, the sellers had beaten them all the way back down.
Exactly. It shows you the intraday volatility and emotion that a simple line chart completely erases.
Okay, so that makes step two, identifying the pattern, much more robust. You're scanning those candlesticks, looking for the wicks and bodies to form our head and shoulders or our triangles, which leads us to step three. And according to our notes, this is where the professionals separate themselves from the amateurs. Step three is confirm the pattern.
Yeah, this is huge. A pattern in a vacuum is essentially meaningless. You cannot trust your eyes alone. You have to confirm the thesis with other metrics, and the most vital technical indicator for this is trading volume.
Volume, meaning the actual number of shares changing hands.
Yes.
How does volume confirm a shape, though?
Let's say you spot a triangle pattern, right? And the price suddenly breaks out upward. It looks like the coiled spring has released. But when you check the trading volume, it's virtually non-existent. Hardly anyone is trading the stock that day.
Oh, I see.
That tells you the breakout is likely a fake out. The broader market hasn't actually bought into the narrative. For a pattern to be valid, you need high volume to prove that real conviction is driving the move. You should also confirm it using fundamental analysis, looking at the company's actual earnings, debt, and leadership.
So it's kind of like gathering witness testimony to back up the circumstantial evidence on the chart.
That's a great analogy, yeah.
Okay, so that brings us to step four, setting trading parameters. Let's ground this with a concrete scenario. You and I are looking at a stock, let's just call it Company X. We spot our quirky head and shoulders pattern on a candlestick chart. The right shoulder just formed. We check the volume. It confirms our thesis. We check the fundamentals, and they look shaky. We are convinced a massive drop is coming. How do we actually structure the trade?
Well, we establish strict parameters before we ever click a button. First, we identify the neckline.
The neckline.
Yeah, if the three peaks are the head and shoulders, the neckline is the floor connecting the low points between them. It is the support level the stock has repeatedly bounced off of.
So it's basically the trap door.
Exactly. And if the price falls through that trap door, the pattern is complete and the plummet begins. So whether you are trying to short the stock to profit off the drop, or you already own shares and want to protect your investment, you set a stop-loss order just below that neckline.
Oh, okay. Break down the stop loss for me.
A stop-loss is just an automatic instruction to your broker to sell your position if the price hits that specific number. It is an emotional circuit breaker designed entirely to protect your capital.
But we also set a take profit level, right?
Yes. You measure the vertical height from the top of the head down to the neckline. Technical theory suggests the ensuing drop will be roughly equal to that height. So you set your take profit order at that target depth. When the stock hits it, the system automatically cashes you out, locking in your gains before the market bounces back.
Okay, but wait. This concrete example reveals a huge contradiction here.
Oh, how so?
We are spending all this time drawing necklines and setting stop losses to catch us when we fall. The very act of setting a stop loss is an admission that these magical shapes aren't guaranteed.
Yep.
I mean, if the patterns were a sure thing, we'd just empty our bank accounts, trade the shapes, and buy a private island.
You have just stumbled into the exact reason the CFA Institute issues such strong warnings about this methodology. And honestly, it transitions us perfectly into the common pitfalls of technical analysis.
It really brings me back to the cloud watching analogy we started with, but honestly, based on what we're discussing, it feels much more dangerous. It is practically a financial Rorschach ink blot test.
The Rorschach test is the absolute most accurate way to describe the subjectivity problem. You see, human beings suffer from apophenia.
Apophenia?
Right. We're evolutionarily hardwired to perceive meaningful connections between completely unrelated things. It's a survival trait. I mean, our ancestors needed to recognize the pattern of a tiger hiding in the brush. But in modern finance, our brains will apply that exact same survival instinct to a candlestick chart.
Wow. We want the chaos of the market to make sense, so we invent a tiger in the brush. We force a pattern to exist simply because we want to see it.
Spot on. And because of that subjectivity, you can put two highly intelligent, experienced traders in a room, give them the exact same chart for company X on the exact same day, and they will draw completely opposite conclusions.
No way.
Yes. One trader sees a double top signaling a crash. The other draws their line slightly differently and sees a triangle signaling a massive rally.
That subjectivity leads directly into the biggest misconception our sources highlight, which is the illusion of certainty. Like, new investors read a textbook on chart patterns and assume they've been handed a crystal ball.
It is the most dangerous trap in investing. We have to be unequivocally clear. Past performance does not dictate future results. A chart pattern only shows you the historical record of a psychological battle that already happened.
Right, it's just the past.
Exactly. It might suggest a probability for what happens next, but the market is a complex living ecosystem. It offers absolutely zero guarantees.
Plus, the market doesn't exist in a vacuum. I imagine you could have a perfectly drawn pattern like a triangle continuation that belongs in an art museum, and some outside force could just obliterate it in 3 seconds.
Oh, it happens every single day. You have your beautiful technical setup, and then an unexpected news event drops. A massive economic indicator is released by the government showing inflation spiking. Or a geopolitical crisis breaks out overseas. Or the company suddenly announces a horrific earnings miss.
So the chart might be whispering up, but if the macroeconomic reality is screaming down, reality is going to win.
Every time. Fundamental economic realities act like a bulldozer to a stock chart. The news simply does not care about the elegant head and shoulders pattern you spend an hour drawing on your screen. The market will react to the new information and shatter the pattern instantly.
Okay, so we have this incredible tool that visually maps human psychology, but our own psychology can trick us into seeing fake shapes, and even the real shapes can be destroyed by sudden news.
Yep.
How does a listener synthesize all this? How do we use this visual language without falling into the Rorschach trap?
Synthesizing the advice from all our sources, Investopedia, the CFA Institute, the academic skeptics, it really comes down to understanding perspective. Chart patterns are fantastic, indispensable tools for highlighting potential opportunities that you might have otherwise completely missed. They give you a framework for understanding the battlefield.
But they are just one tool in a much larger toolbox. You wouldn't build an entire house using only a tape measure, and you shouldn't build an investment portfolio relying solely on chart shapes.
Which leads to the golden rule of this deep dive. Chart patterns must always be used in conjunction with fundamental analysis. Before you trade the M of a double top, you need to read the balance sheet.
Right, look at the actual business.
Exactly. You need to understand the company's debt, its competitive advantage, and the broader economic environment. The fundamentals tell you what to buy, while the technical chart patterns might help you decide when to buy it.
You know, looking at everything we've unpacked, I think the most surprising takeaway for me is the shift in purpose. We spent the first half of this discussion talking about predicting where the price is going to go. But based on the vulnerabilities we've discussed, it seems like the real superpower of chart patterns isn't prediction at all. The real power is risk management.
I am thrilled you arrived at that conclusion because that is the most mature way to view technical analysis.
So you aren't using the neckline of a Head and Shoulders to predict the future with absolute certainty. You are using it to create a logical, emotionless plan.
Exactly.
You are basically saying, if the price falls below this specific line, my thesis is officially broken, the psychology has turned against me, and I have a pre-planned place to exit and protect my capital.
It provides structure in an environment that is designed to make you panic. Setting those stop-loss and take-profit parameters forces you to admit where you are wrong. And knowing exactly when you were wrong and having an automated system to pull you out before small losses become catastrophic ones is arguably more valuable than knowing when you are right.
We have covered a massive amount of ground today, navigating the tension between the traders on the floor and the academics in the classroom. From the exhaustion of buyers in a Head and Shoulders, to the bag holder regret of a double top, to the coiled spring of a triangle. Before we wrap this up, what is a final thought you want to leave simmering in the listener's mind?
I really want to circle back to that apophenia concept, the human tendency to find order in chaos. The next time you pull up a stock chart and start drawing lines, take a step back and ask yourself a very hard question. Are you genuinely uncovering a repeatable pattern of market psychology supported by volume and fundamental data? Or is your brain just frantically trying to find a comforting shape to protect you from the terrifying randomness of the market?
That's all for this weekend's deep dive. Come back tomorrow for more investor education and weekdays for daily market coverage. Like, subscribe, and we'll see you next time on Tech Money Madness.